Hello, everybody. How you doing? How's my sound doing today? Before I get going, let's see. What do you think? Do I sound okay? Anybody? Last time there was a sound problem. Good. Thank you, Travis. So I'm doing YouTube. I'm doing these less frequently because I don't really love doing them, actually. I guess I'm a little more introverted than many of you might realize. So I'm doing them when there's a really good reason to do them. And I think there's definitely a very good reason to do it now, since I've talked about AYX for, I don't know, I think at least a year, maybe 6 months. And it's my biggest position. And we found out on Tuesday or Wednesday, Reuters reported that they are in a process and that they have received bids from private equity firms, and that so far none of the prices have hit their the price indications have not met their expectations. So there's really a lot to talk about with Alteryx. So I don't even know exactly where to begin. I guess we could focus on the article first, and then I'll explain to you why I'm so bullish on a transaction ultimately occurring, or the stock just being significantly higher than it is today. So the article came out like around 10 a.m., let's say, Pacific. And the original article just said what I just told you it said, that they hired Catalyst Partners, which is, the biggest advisory firm for software companies in the world, to field incoming bids, and that none of the incoming bids so far met their price expectations, and they could remain public. About, I don't know, 8 hours later, it was at 4 p.m. Pacific, 6 hours later, they updated the article, and they put 2 new paragraphs in the article. And both of those paragraphs were sourced by one person. So not multiple sources, but a single source. The first paragraph says that Insight Partners, which owns 1.5% of the company, has recused themselves from the board during the deliberations because they may participate in any deal. The second paragraph said that the founder, who I'll remind you has super voting shares and controls the whole thing, may roll his stake in any transaction. But he hasn't decided whether he's going to do that or not. I think that update is incredibly important, and I'll tell you why. So the risk, of course, in this whole thing is the line about how pricing hasn't met expectations. And just recently, Sentinel-1 was the subject of a similar article by the same author just a few weeks ago. And it had the exact same line in it. And sure enough, the CEO came out last week in Sentinel-1 and said, "We are not for sale." So clearly, if they were in a process, the process failed for Sentinel-1 with that exact same line in it. Why I'm much more constructive here is there is a reason for everything. And if 6 hours went by and a source showed up to implant those 2 paragraphs, well, one, the process definitely isn't dead, because it's not really relevant that Insight is interested in participating or possibly participating, and 2, that the founder is looking to roll his stake, right? If the process had stalled and the pricing was bad, then you wouldn't call up a reporter to tell her that news so that she could update her article. So I very much believe the process is alive and well. The next thing that happened was this morning, the CFO presented at a conference, and my takeaways from that are exactly what I thought they were a month ago, which is that this business is going to do better than they guided to for the full year 2023. And they went incredibly conservative 4 weeks ago to make sure that they can beat and raise in Q3 and for Q4. Historically, they've always beaten and raised, and they've beaten and raised by pretty significant amounts. And he made it very clear that they are not used to missing. And it was very uncomfortable what happened last quarter, and it happened 2 quarters in a row. So the CEO said the same thing on the conference call. So, my thought process from earnings perspective is that we have very little earnings risk going into November earnings. And for the first time in now 3 quarters, you actually might have it go up 20% or 30%, not down 20% or 30% on the print. He was asked at the end about the rumors, and he says they won't comment on rumors. So, where do we begin here? Because I really think this is just a ridiculously interesting situation, and I made this a huge position. So I have a 75% delta adjusted position in this. That's a mixture of, I think, a third of it is common. So my common position is like 25%, but the other 50% delta adjusted is a gigantic amount of call spreads across every month that exists. The majority of them are in November, February, then April, then June, and then Jan 25. I put these all on before this happened. I put these all on in the last 4 weeks, mostly after it blew up. And the call spreads range from a 35 strike and a 40 strike on the buy side to where I'm significantly short, 50, 55, and 60 lines. And I have more short calls on than long calls, but I'm more than covered with my common. But it's a lot of 1x2s, things like that. If you look at, there's a few things I want to talk about today about this company, and I think these are the most important takeaways from the situation. So, in last quarter, the company provides you some interesting metrics. I talked about this before on here, but I just can't really emphasize it enough. I'm going to give you a link here. I want you to open it up. And then after you open it up, click on supplemental financials for the second quarter of 2023. Unless that link is that. I don't even know what that link is. I don't think that's the link to that. Supplemental financials, second quarter 2023. Here's a direct link to that. If you can't find it. Okay, that's a direct link. Now, the 3 most important things in this grid, hold on, and why I believe the business is not impaired in any way is a dollar-based net expansion rate, global $2,000 based net expansion rate, and customers with AR of 250,000 or greater. Okay. Why don't we define what these things are? So actually, they define it. I don't have to do it for you. Oh, sorry. Once you get to open that link, I apologize. Click on Other Business Metrics. It's one of the tabs on the top. So go to Other Business Metrics, and definitions will define what these things are. You could read it for yourself. But to put it simply, dollar-based net expansion rate basically takes your existing customer base for the previous 12 months, and it measures how much business you're doing with them versus the previous 12 months before that. Think of it like same-store sales, okay? And Dan, and it's the best way to measure retention and how your existing business is doing, not from new customers, but from your current customer base. And as you can see, since they started reporting this in quarter 1, 2021, it's been incredibly stable at about 120%. And in the last 2 quarters, when they missed, it hasn't inched. It hasn't moved. It went from 121 to 120. And the more important metric, the global 2000, is at an all-time high of 131. What this means is, for every dollar of business they had from a customer in the 12 months preceding quarter 2, 2022, in the 12 months preceding quarter 2, 2023, those global 2000 customers increased their business by 31%. Okay? If they were losing customers, that would be a negative number. It'd be like 90% or 95%. Or maybe they were losing customers, but they were increasing business at some customers. So net, it might still be over 100, but it wouldn't be anywhere near to the levels that it's at there. To confirm this point, If you go down to customers with AR of 250,000 or greater, that metric has steadily climbed since they started giving it in Q1 2022. And it increased by 29 customers last quarter versus 17 customers the quarter before. Now, Q4 to Q3 isn't a fair comp because that's the biggest quarter of the year, Q4. But it's growing at a very healthy clip. Okay? No signs whatsoever of distress in the business. So why did they miss and why did they guide down? Well, you can take them on their word for it because these numbers would be different if what they were saying wasn't true. They missed and they guided down because they're not getting new business outside of a renewal period. So new customers and incremental new business, not when there's a renewal. Okay? They were asked on the call today about this, and he did not guide or say that you should expect these numbers to be impaired in the coming quarters. Okay? He just kept saying that they're being very conservative now going forward. A sell-sider did math and said that given how much renewals are in Q4, that retention rate would have to fall dramatically from the 120% for them to miss their guidance. Okay, I'll repeat that. In order for the guidance to be missed, that 120, which they've been doing pretty much for 12 straight quarters, would have to go down significantly, I think to like 105 or 110. It's not going to happen. Okay, so that's what gives me confidence that a private equity firm can come in here. They see the underlying business is sound. It's growing at a healthy clip. It was growing at mid-20s ARR a year, and now they're guiding to basically, teens ARR a year, which is completely sandbagged. And if you look at what other software companies that are growing at mid-teens ARR that have similar gross margins, this company has one of the best gross margins in the whole space at very high 80s. Okay, other ones that have been taken out, the gross margins range from the high 60s to the high 70s. So when you're using a multiple of revenue, the multiple gross profit was substantially higher than a multiple of revenue. So it's not even the correct comp to use a multiple of revenue when your gross margin is so different. But for just to be conservative and for the elements of simplicity, I'm going to use multiples of revenue to show you how everybody can make out like a bandit here at an extreme significant premium to where it's trading. So the most recent takeout and the most recent comp is New Relic. Okay, and it happened in July of this year. Now, New Relic was sold for $6.5 billion, but there's $500 million in net cash. So the EV is $6 billion. Okay. Their fiscal year is not calendar end, but it was sold for 5.82 times fiscal year 2024, which is like, I think, like the end of the summer for 2024. So it's not a perfect comp to Alteryx 2024 revenue guidance, but you can haircut it by like a couple percent because you're off by 6 months. But anyway, that's what I'm going to comp it to, okay? It was sold for 5.82 times fiscal year 2024 revenue. And its gross margins, like I said, are 1,000 basis points lower than Alteryx. And its growth rate was comparable, but now is a little bit better given the new guidance from Alteryx. They're also the same size companies. New Relic's going to do about $1 billion in sales in fiscal year 24, and Alteryx should do about $1.1 billion in sales next year. So my estimates for Alteryx is $950 million this year, higher than guidance by a little bit, and then they grow by about 16% next year to be conservative. I think it'll probably end up being 20% to $1.1 billion. Just using New Relic as a comp. Okay. Again, this deal was just signed in July, and they funded it with a $2.25 billion of debt, and the rest of it's all going to be equity. Okay. So the financing markets were exactly the same as they are today. So it's a great comp when it comes to seeing what could be, how this could be financed and what kind of leverage they can use. At 6 times sales, AYX is worth $76 a share. I'm using 80 million share count to be conservative. It's closer to 77 million as of December 31st. You cannot count the PSUs in your share count because they will not vest until they're 90. Even on a change in control, they do not vest. So I'm using 80 million as a share count. I'm using 500 million as net debt, which is I'm taking current assets and I'm taking out all liabilities except deferred revenue. And I get to 500 million of net debt. At 5 times revenue, it's 62.50. And at 4 times revenue, it's 48.75. So right now, a private equity firm can acquire Alteryx at $50 a share for a hair above 4 times sales versus the 5.82 times sales New Relic was just taken out a month ago. That 1.8 turns is a huge amount of money. We're talking almost $2 billion. The last deal that was done before this was Coupa Software, ticker COUP. That was done at the beginning of this year, and those multiples were insane. That was an 8 billion EV deal, and fiscal year 23 sales were 840 million. And maybe the following year was probably like $1 billion or something. So it was 8 times forward sales. To make this even more interesting, it was pointed out to me that Bravo has 2 portfolio companies that would fit perfectly with Alteryx. Okay. The company is called Quick. Hold on, I'll send you a link about it. Click, excuse me. And Talent. Okay. So check this out. So Thomas Bravo, or Thomas Bravo, what is it? Thomas Bravo has 2 portfolio companies, Click and Talent. They bought Click in 2016. They bought Talent in 2021. They merged them together this year. Okay. If you read the press release I just sent you, you can see how this is all very similar to what Alteryx does, but they don't compete. I believe Bravo can acquire Alteryx at a 5 times sales multiple. Okay. A year from now, merge it with these 2 companies, cut out a ridiculous amount of money out of sales and marketing, and sell them all together. And it would be worth billions to them because of the synergies. You don't even need synergies at a 5 times sales multiple. These businesses used to be acquired for 7 or 8 times. The only reason why this is trading at $35 a share is because they missed earnings twice, good reason, and people are worried about AI. Okay, AI is the big elephant in the room here. And I'm not going to sit here and tell you I even understand what Alteryx does. But if AI was a problem, it would be showing up in the net retention numbers, and it would be showing up the number of customers with greater than 250,000 ARR. And they're only growing, right? So I think that all you need is a single private equity firm to use the weakness in the stock price as an opportunity for them to buy it is currently the cheapest SaaS stock in the market. That's, has any growth whatsoever. What I did today, which I think you guys should all do, is I went back and read the proxy from Coop. And there are so many parallels here. Okay. Well, first of all, when Coop got acquired, they were similar it was very similar to Alteryx at the time. The stock prices and valuations were similar. They had similar revenue numbers. Coop was more profitable though. And when they were originally approached by private equity, Coop, in September of 2022, Coop was trading in the low 60s and private equity offered like high 70s, something like that. Okay. And they said, we don't think that premium is going to work. Subsequently, Coop blew up. Stock went to the mid 40s. Okay. Private equity continued to negotiate with them the entire time. At the middle to the end of November, it was leaked that Vista was looking to acquire Coop with no price attached. Coop popped to like 63 or 64 or something from the 44. Okay. On December 12th, the day of earnings, Coop was acquired by Bravo and they paid $81 or $82 a share. A small premium to its original bid back in September. The reason why I think this is so interesting is it's my belief that private equity probably approached Alteryx after May, maybe in June, after the first blow up. The stock was trading high 30s. They probably offered like 50. Alteryx said no. Alteryx blew up again. Stock went to high 20s. Private equity lowered their bid to low to mid 40s. And that's where we are today. And ultimately, private equity will get back to the $50, $52, $53 price point, and they will acquire the company. What's so interesting about the way the model works for private equity right now in this environment is since they can put such little debt on these businesses, you can't buy them unless you're a strategic or you're merging it with a strategic. You can't buy them at these lofty 8, 7, 9 times sales multiples. It simply doesn't work. You can't write an equity check for that and have the IRRs work. But in this case, at a 5 times multiple, which gets you to $62 a share, the math works like a motherfucker. Okay. This business should double in revenues in 5 years. And then when that happens, operating margin should explode. And if you have the added benefit of being able to roll it in with a portfolio company and cut out, $100 or $200 million of costs, all that gets capitalized at whatever the exit rate is. So if this, let's say Bravo rolls us in with the other 2 portfolio companies and they IPO it, 4 or 5 years from now, and it's this diversified large business, and it gets an 8, 9, 10 times sales multiple, similar to what very high quality, large, diversified software companies can get. I mean, the amount of money they'll make is insane, right? You've doubled the revenues, you've taken out the $100 or $200 million of costs, that gets capitalized at 8 or 9 times. The doubling the revenues gets capitalized 8 or 9 times, and you get to bring up the multiple from what you paid. You paid 5 and now it's worth 8. Okay, it's nuts. It's a crazy return. So what are the risks here? Well, the first risk is that the founder decides he doesn't want to sell, but he's interested in rolling his position. So the way I look at it is, if the bids are too low, but they're high enough for the board to accept, and he thinks it's worth more than that, he'll just roll his whole position. If the bids are high, he'll take some off the table and he'll roll the rest. One nice thing about this is because there'll be such little debt, net new debt put on this business, he is really in no situation to rob us because he's not putting in any net new money. So he should still own a similar percent or smaller percent of the company after it goes private, depending on whether he takes money off the table or not. As long as he owns a similar percent or a smaller percent, he is not incentivized to get the lowest price possible. In fact, he's incentivized to get the highest price possible because he's taking money off the table. Further, the sanity check we have is that if he does participate, minority holders will get a vote. And Clearly, that's a place for an activist if they try to rob and steal the company. So what does stealing the company even look like, though? It's trading $35 right now. Okay, $48.75 is 4 times sales. Okay. The last article said that the initial reach outs did not meet their expectations. Well, we know it's not below $40 a share, right? Private equity didn't bid 40 when it's trading 30, less than 40 when it's trading 30, I think, and they had any kind of real opportunity of getting this company. So the initial expectations are probably somewhere in the 40s. We don't know if it's 42, 45, or 48. Go back and read the coup process. It started in September, it ended in December, and it was a hot and heavy kind of back and forth with the company till the very end. And it's always like this. The price is not agreed upon 6 weeks before they sign the deal. Price is agreed upon the day before they sign the deal, usually. So, of course, there is no price met yet, right? You could say that for any process as it's going along. They want to get the best price they could get. They're not going to say they're happy with the price that have come in. But where I think the market's getting this one way wrong is in the downside. I only see downside in Alteryx if they miss Q3 and they guide down Q4. And I can't see how that happens after the reset they just did and after the math we just went through with the net retention rates. So if you can get comfortable with the Q3 guide and the Q4 guide, I think you make money here either way. It goes up to 40 or higher on the beating earnings and raising Q4 guidance, or you get 45 to 55 in a sale. And it's very rare to have that kind of setup, right? This is not implying any premium for a deal. The stock went from 30 to 35. So ARBs that maybe aren't that familiar with the story think there's a $5 at risk here. But I believe it's only $5 at risk if they blow the quarter, right? I think it's massively oversold. And I have a strong reason to believe that they will crush the quarter. Well, crush guidance, I should say. Because they weren't going to put themselves in a position again to fuck up. That is a good setup. And unfortunately, when it comes to the spreads, they're not as sexy as they once were because the outer strikes have all gotten crushed. But the way I like to play it the best right now, and honestly, this could change any day based on what it's trading at, is I really like November 40 calls and December 40 calls. December gives you a little bit more time, obviously. I think this could be done by November. I think they'll want to do it before earnings. It gets a little more complicated if the founder rolls a stake, because that might take many weeks to figure out how you structure that. I like February 40, 50 call spreads because there's 3 different ways to win there. You win with the November earnings. You win with, you get to see Q4 earnings and 2024 guide. And of course, you win with the takeout. And it's so far out that if a takeout's announced by November, you might even get a close of the deal by then. And if the stock, if the deal is below 50, it's going to trade at a spread until it closes. You know, 5, 6, 7% kind of gross, maybe 8% gross spread, or excuse me, IRR, 6 to 8% IRR. So the gross spread might be 2% or 3% or something. So that's how I would position myself. And I think common is probably the best way to play it because I don't see the risk in it. You know, they're in the massive penalty box right now for missing 2 quarters and sandbagging guidance. I mean, just destroying the 2023 guidance. And I think people are anchoring on where the stock price was and not what a fair value is in the deal. And I think Coop is a great example of that, right? 44 to 82, whatever it was, 81 or 82. That's a huge premium. But the 44 was at the absolute lows and it was very depressed. People aren't giving Alteryx the benefit of the doubt here. And you know, the biggest positive here is that the founder controls the vote. And we know they're in a process right now. I was just speculating that I thought he would be open to a sale, but now we know they are. And it's very hard for me to see how it ends without a sale, given the distress of the business from a public markets perspective and how much money can be made by everybody in a takeout. They're going to steal it. Make no mistake about it. If they sell it for 50 or 55, they've stolen it, right? A fair value of this business is in the 60s. It's in the 60s. That's not going to happen. All right. I think I've talked enough. And yes, Dan, this is Banana Republic. These are the shirts that you like. I don't really like them that much. I like the soft wash tee, and this is exactly what you think it is. Can you speak to why November is your best guess's time frame? So the coup process started in mid-September and it ended December 12th. And the article came out the third week of November. My gut tells me this has been going on for longer than the month of August. They reported earnings 4 weeks ago. I doubt they got indications of interest within 2 weeks of hiring Catalyst. My guess is that they had incoming interest in June and in July, and they've been working on this since then. So, I do wonder about antitrust here with Bravo. My buddy who used to work at one of those companies, Click, says he doesn't think there'd be any antitrust stuff. But I did wonder that too, whether there'd be any antitrust stuff. I don't think these businesses are that important. My brother just popped in. That's hilarious. See that, guys? Brian Turk in the house. He's probably not here anymore. I'm sure he's super bored. Any other questions on Alteryx? Then I'm going to talk about BBIO. So look, I don't know if it'll happen by November. I also think the company will want to do it by earnings. And you could also get another article leak. If I was gun to head, I think that the minimum sale price is $47.50. And if I had to wager one or the other, it would be above 50, not below 50. And I know that's crazy with it trading at $34.73, but the math is the math. So BBIO has been weak, and I made it a very big position again. I think the odds of a secondary are very unlikely at this point. So basically, all we're doing is sitting around waiting for how they raise their capital. Do they do a partnership or do they do a royalty deal? And I think whichever one of those two things they do, the stock price goes much higher because it'll be fully funded forever until they get profitable. I think the odds of a full sale are low, but crazier things have happened. I just don't think that's likely. So for me at this price point, I think that it's a great setup. And we're just kind of waiting around for the catalysts. I think it's been weak because they announced they're going to a conference next week, and people assume they're not going to sell the company if they're going to a conference. And that's just not true. But I do think the odds of a sale are probably less than 15%, given how complicated the company is with all the different diverse assets. But I think that this management team, the CEO and the CFO, are so impressive. And you go look at the bio on LinkedIn of the CFO. I mean, this guy knows what he's doing. And they've only done one secondary in 4 years. The other secondary was not a primary secondary. It was for selling shareholders of KKR. A single secondary in March of this year. So, they are very wary of dilution because they own so much stock. And I think the setup for BBIO over the next 24 months is tremendous. I think all three of the assets that are in the pipeline are winners. All have proof of concept and all very likely to be successful in phase 3. All have, 500 million plus, billion plus revenue opportunities individually. And I think that this lead asset is going to be a winner. So it's my favorite biotech by far. I bought more Cure, by the way. That blew up because of S&P 600 deletion, which is crazy. That's a very big position of mine too, but that's very different than BBIO. Cure has, $12 a share in net cash, and is trading at $8. And people think it's all worthless. So I don't need to get back into why I own Cure, but to me, I think you're just playing, time there. And at any moment, you can wake up to something good happening there. But it's very different than BBIO. Sphere's opening up in a few weeks. I've made that a much smaller position. It's about a 7% position, 7% delta adjusted now. It's been a big winner for me. I still think it's going to be a big success. I just don't want to have such a huge position on going into the opening with U2 and with the movie, because I think that there can be a lot of glitches. And I think that's a fine size position. 7% positions are huge for most people. So for me, I think that works. It's mostly options for me. Very little common. I still have a big position in AQN and AY. Both have been disasters. AQN more than AY. That's been hurt with rates. I think that I still think AY is going to be sold, and it'll benefit AQN. And I think AQN will be successful in selling the renewables. So I'm fine with being oversized in both of those positions. And that basically rounds out my portfolio. MX is like a 7 or 8% position, and everything else is much, much smaller. I have some Roivant. I have some AMPY. It's a few percent. I have a few percent in Lionsgate. I have a few percent in BSM. I have a few percent in ARDX. And that's my whole portfolio. It's gigantic in AYX. Huge in BBIO is like a 35% delta adjusted position. Cure is a 20% delta adjusted position, something like that. And that's basically it. AQN is like a 20% delta adjusted position, and AY is like 14 or 15% delta adjusted position. So, I use a lot of leverage, which is very dangerous. And, I definitely don't recommend that if you don't know what you're doing. And I don't recommend anything if you don't know what you're doing. Give your money to a professional, not me, because I don't know. I can't even tell you what Alteryx does. I tried so hard to understand what the shit is, and it's so beyond my comprehension. Data analytics and mining data and whatever. Not a clue. Which, by the way, if they end up getting eaten by AI, it'll be because I have no idea what they do. And I don't even really understand fucking AI. So, but this is how I've invested for 20 years, and it's worked so far. So I'm hoping Alteryx gets taken out and I could take a lot of time off. That would be my goal. Because the math of a $50 takeout with all the call spreads I have on is just tremendous. I'm not really sure I would change my mind. What would make me change my mind on Alteryx? The other reason, by the way, I think it's going to be taken out is I don't think they can operate as a public company at these low levels, given stock-based compensation needs. So I think the company's aware of that. And just to remind you, Insight Partners. So just to give, I should have touched on this. Insight Partners is a $90 billion firm that was a pre-IPO investor in Alteryx, was their anchor investor, and distributed all their stock to LPs a few years ago, maybe 3 or 4 years ago. In March or February of 2022, Insight bought $50 million of stock in Alteryx in the open market at like mid-50s a share. So they own 1.5% of Alteryx. That's all they own now. And it's a rounding error for them. It's completely irrelevant. But they're a gigantic firm. So they know this business is better than anybody. And having them there as a stalking horse bidder and keeping the other private equity firms honest is huge. It's huge. So, I really believe it'll be a robust process. And given the fact that they paid mid-50s for the stock just, a year and a few months ago, I think it speaks to the volumes of what the potential is here. Anything else? And Roivant is a small position now, but I'm still pretty excited about that one. That's like a 4% position. We'll see what happens with there. But there's a bunch of catalysts with Roivant, with IMVT reporting data, and then we've ever figure out if they sell their main asset, this Pfizer drug they have. Ocular. Did everybody see the CEO of Ocular purchasing $25,000 of stock for his spouse last week? I've seen some crazy insider token purchases in my day. That one is easiest, the worst one I've ever seen. Okay, so first of all, by the CEO buying stock in the open market, it means that the process is completely dead. There is no partnership negotiations anymore. Okay, you can't do that if they're in any form, in any shape, in the middle of a negotiation with a partnership. Okay, so he just signaled to the market that it's all dead. Nice. Further, he bought $25,000 worth of stock, a complete immaterial amount of stock. Like, could not be more immaterial. What's he going to buy? $500 worth of stock? Okay. And then for icing on the cake, he bought it for his spouse, which was her first purchase, by the way, or his first. I don't know if the CEO is married to a man or a female, but it's his spouse's first purchase. It's like gifting your kid a share of Disney World. I am speechless at that company. Now, whether the stock works or not is anyone's guess. They have a bunch of catalysts that could happen in the next 6 to 9 months. I've talked about it on here. The setup is probably better long than it's a short, of course. If they get the coding change in November, the stock should work really well for Dextenza. If they hit on glaucoma readout, the stock should probably double. And then they have, the diabetic retinopathy phase 1 trial that I don't think anyone cares about because it's not even being run correctly. It's being run against placebo, sham, not against an active drug. But yeah, I have better ideas out there than Ocular. So I'm not itching to get back in. ANPY is a small position now. Look, it's very disappointing, that company. Why did the Avenue, who's on the board, blow out of their whole position? If they wanted to sell their position, they could have pushed the board to sell the company. And instead, they just blew it out in the open market. So you can be rest assured that ANPY is not for sale and not going to be sold anytime soon. And that's very disappointing. But I do think that there are large shareholders that are very active in talking to management and trying to hold their feet to the fire. Very, very disappointing situation, but also one where the setup is, tremendous. I think they're going to do 75% of their market cap in free cash flow in 2023, 2024, and 2025. And there's very little debt. So, and they're hedged on like 75% of oil and gas. So there's very little risk there. And you'll end up owning, Remainco at the end of 2025. The market cap, net of cash, will be very small. So there's worse places to put your money than ANPY. But, I'm just starting with a position that it's not marginable, and it's been nothing but a pain in the ass. Lionsgate, don't even get me started on Lionsgate. Steve Mnuchin is an investor now, if you haven't noticed, and he owns Class A shares, voting A shares. So now it's going to be Steve versus MHR trying to battle it out on votes. And I don't want either of those guys deciding for me whether or not the company should be sold or what price it should be sold at. So, Lionsgate is such a piece of shit. And I'm trying to move on from there. It's now just a few percent of my portfolio. And, I'm trying to sell it all out, quite frankly. So that just didn't work. Very disappointing. And there's better places for me to put my money. All right. That was fun. Well, the next time you guys hear from me, it'll probably be on a BBIO deal or a AYX deal. Or if not before then, it'll be after Sphere opens. Let me talk about Sphere. I'm not going to Vegas until the middle of October to see it, but I cannot wait to hear about it. Hope everyone has a nice weekend. Thanks for tuning in. Take care. Bye.